Okay, this week's market outlook. We'll start off with a summary, we'll go into the news events this week, and then we'll do the individual currencies and end it with the technicals. So, starting off with the summary. Last week, the US dollar finished the week broadly unchanged despite softer than expected June CPI and PPI, which obviously we got last week. As markets questioned whether the improvement in inflation would last. So attention quickly shifted to essentially the geopolitics and the situation in US and Iran, which ended up pushing oil prices higher at the end of the week. I believe we closed at $82. That's on WTI. So yeah, with June's disinflation largely driven by lower energy costs, the rebound in crude this week is obviously countering that, which is going to limit the downside pressure on the dollar and short end yields. So that's kind of what happened last week and why we kind of saw the dollar just stay pretty stagnant. As we mentioned in last week's Outlook, which was released in the research section, obviously I didn't do the recordings for the last 2 weeks because I've been abroad, but I've been releasing them in the research section inside Cognito itself. We mentioned that the carry trade would continue to outperform, and it has done so. We've seen a lot of pound upside and AUD upside against the lower yielders. So yeah, that's kind of the summary. We'll go into the calendar now. So starting on the Monday, we have inflation coming out of Canada, which is looking to slip a tiny bit, and then we have Q-on-Q inflation out of New Zealand, which is looking to accelerate by 5 basis points. Tuesday, we've got unemployment, or I should say the labour market data coming out of the UK. That's all I'm kind of really paying attention for. Wednesday, we have CPI out the UK. Thursday, we have the ECB rate decision, which is forecasted to be a rate hold as of now. That's obviously going to be very important. And then on Friday, we have inflation out of Japan and a lot of S&P PMIs. So yeah, that is the week ahead. Pretty. I wouldn't say it's busy, but I wouldn't say it's quiet. It's kind of in the middle, which is kind of good for us because we want to get in on the pullbacks. We don't want to get caught out by CPI or NFP from the US, whatever. But quite a week for the US, so we should be good, hopefully. Moving on to the currencies. So starting off with the US dollar, we are neutral this week. I mean, yields in the US clearly want to fall. We've seen softer NFP and CPI numbers with the 5-year inflation expectations showing a clear downward trajectory as well. The only reason we haven't seen the twos dump as well as the dollar at the moment is due to the Middle East risk. So it's obviously US oil prices continue to slowly creep up with prices closing at $82.50 on the Friday. As of now, the war is still very much ongoing, with minimal signs of it slowing down anytime soon, even with midterms approaching. I mean, just this morning, like whenever you open Twitter, I like to look at BRICS info and see what they've come out and said, and it's just continual strikes. The US have launched more strikes. The Iran have fought back. The US have launched more strikes. It's just back and forth, back and forth, back and forth. So it doesn't look like at the moment we're going to be getting too much de-escalation, which is why we've seen oil have its rise and probably maintain its bid this week unless we get some good news out of the Middle East. So yeah, that's why the macro and the data is pointing to the downside for the dollar, but the geopolitical risk is pointing to the upside. So we are neutral at the moment. Doesn't mean we're not going to trade it. There's one pair I'm a big fan of, which is dollar Swiss, for reasons we'll go over. But yeah, that's that. I mean, equities took a hit last week as well. However, this wasn't linked to the hawkish or dovish repricing, I should say, in the short end. It was actually more semiconductor related, so it shouldn't impact FX or the dollar at least as much as of right now. Institutionally, MUFG and JP Morgan are both bearish on the dollar. So if we go to the insights, we look at the dollar, we can see here that JP Morgan are actually bearish on the dollar post CPI yield weakness. So are MUFG, short dollar, whereas Bank of America are actually bullish on the dollar. So yeah, there's not a clear consensus among institutions either, which is why we're neutral. So now onto the pound. We are bullish on the pound. Short end gilts remain supported amid the Middle East conflict from higher oil prices. And from a rate differential perspective, this is supporting the pound on the majority of crosses. Also coupling the carry advantage that the UK has at the moment, and it's quite appealing. One slight concern is the 30-year, which is creeping up following the past month's political mayhem surrounding Andy Burnham, the resignation of Starmer, all the different fiscal changes, etc. All I care about is what's happening to the 30-year. Is the market pricing it in as bad for the pound or good for the pound? And at the moment, we're seeing it being priced in as bad for the pound. As of now, it's not impacting the pound. However, it's something to be aware of for sure. The data out of the UK last week surprised to the upside, with GDP coming in at 0.1%, I believe, which is 10 basis points above consensus, if I'm correct. I believe which is going to support the upside in the short term, at least for the pound. However, as soon as we see any de-escalation in the Middle East, I'm looking to pivot short on the pound. I think macro data is obviously very, very sluggish. Unemployment's at like I think last month it ticked 10 basis point lower, but I mean we were at like a 5-year high. Growth is super sluggish, even though we had a stronger print on Friday. It's still super sluggish, and inflation seems to be topping out, or seems to have topped out. So yeah, that's kind of why I think as soon as we see de-escalation and we see the short end gilts reprice, the pound's going to struggle against the likes of the AUD, the NZD, the Euro. So yeah, that's what I'm looking at there. Data-wise, UK CPI is one of the main releases this week, which is expected to remain somewhat sticky, as well as the labour market, which is looking to remain consistent with last print's reading. So at the moment, it's a pretty neutral week data-wise. That's consensus, of course. The real print is going to change. Euro, we are bullish on the euro, however, only on specific crosses. So basically, the euro is in the exact same boat as the pound. This week, its movements are going to all be centered around the Middle East developments and how US oil moves. At the moment, the market is clearly pricing in conflict, and therefore we are seeing the front end elevated in correlation with US oil's price movements. However, I'd only be pairing this up against lower yielders just because of how strong the carry trade's been as of late. So Euro Swiss, I think, is pretty much the only position I'll be looking to take, and I think apart from that, the euro is pretty neutral. The ECB rate decision is the main event to be on the watch list for this week, which is a consensus rate hold as of now. I think that's pretty consensus. I mean, ECB path here, 99% chance of a hold. So the hold isn't going to do much to markets. What is going to do stuff is the ECB press conference with Lagarde. So yeah, that is that. Moving on to, we're going to skip the CAD this week because, to be honest, I just don't like trading it when oil's doing one thing. It's all dependent on oil at the moment. Oil's doing one thing, the macro's doing another thing. It's neutral. It's not. There's so much cleaner crosses out there, which I'm just going to leave it. Now the Australian dollar and New Zealand dollar. So we are seeing the Chinese yuan gain a lot of strength against the USD, which should continue to support the China proxies as of now. I mean, equities took a hit at the end of last week. However, I'm expecting the markets to fade this throughout the week ahead, which should also support the higher beta currencies. The short end continues to range in Australia, therefore I'd only really be looking for AUD Swiss upside, as we have been. In New Zealand, we're actually seeing a more aggressive repricing in the front end, which should continue to support the Kiwi, especially against the lower yielders. Data-wise, we've got New Zealand CPI on Monday, which is forecasted to come in above consensus, or above the previous print, sorry. And unemployment data in Australia is expected to stay pretty flat. So yeah, institutionally, JP Morgan are bullish on AUD, and that's about it for the institutions. There's not a lot going on. CAD, as we mentioned, neutral. Moving on to the yen. Well, the yen's going to be very quick as well, to be honest. We're neutral. The intervention risk is too high at the moment. I'm still going to look for setups, but 1-to-1s in and out. I don't want to be holding for 1-to-3s, 1-to-4s, because, I mean, they could just flick the switch any minute. Moving on to the Swiss. I mean, we're pretty much staying with our bias as we have been over the past, I don't even know how long we've been calling Swiss weakness. Pretty simple. Global yields remain elevated, and they're going to continue to put pressure on the funding currencies and also commodities, in my opinion, which is why we think G-Swiss, A-Swiss and NZD Swiss are all great ways of expressing short Swiss positioning. Institutionally, JP Morgan are also maintaining their short Swiss franc positions. So yeah, that is the individual currencies this week. Now let's jump into the technicals. So, starting with the dollar against the Swiss, I think this level here is extremely appealing, just below the 0.805. Obviously, we're neutral on the dollar, but I think as long as geopolitical pressures keep up, something like this makes a lot of sense. Maybe targeting a 1 to 2.5. What's that? New York highs. Yeah. Yeah. So yeah, I'll be looking at that there. G Swiss. Similar thesis. This level is like a very big if. However, this level here, I'm more than happy to get into the 1079 for sure. This is the 108.25, I believe. Yeah. GJ, as mentioned, careful on yen crosses, but 217 looks nice for upside. GU similar 134. Euro pound, this is definitely more risky. It's very carry based, but I think this level here is very nice. 8525. Euro NZD was super overextended. I didn't manage to get in a position on this last week, which is annoying because I mean, we literally from market open just melted, which would have been a lovely position to catch. Euro AUD, this has been a lot easier to get in on. I think this level here, which we rejected on Friday, is a nice level. Euro Swiss for upside, I think this level makes a lot of sense. Ignore these big wicks, this is just market rollover. This is what I'm looking at here. NZD dollar, this level here looks very nice. NZD Swiss, it's a tough one. I'm kind of waiting for structure to be made. Sorry, so maybe we get something like this. Come down, have a bounce, and then we get in there for the continuation here. That's what I'm kind of looking at. NZD CAD, this bounce here or here. AUD NZD downside here makes sense. AUD Swiss upside there makes sense, and that is it. ES, I am looking to fade it for sure. I think maybe a bounce from here makes sense. 7450, something like that. A bounce from there would definitely make sense. We take out these lows and we bounce from there, or we get it. We come down into this level here, but I just don't think I don't really see that happening. Yeah, that's kind of what I'm looking at. So yeah, that is the technicals. That's the whole outlook for the week ahead. Apologies for the absent recordings for the last 2 weeks. Obviously, I've been away. But yeah, back to the normal schedule now, and I'll catch you in the next one.